This no change is a bad news in the sense the world economy seems not being strong enough to bear a rise in US interest rates. The positive news is that the US economy is doing okay and further improvements are expected by the Fed on consumption, labor and the housing market. The Fed has left the door opened and is ready to hike even in its next October meeting. To change its policy in October, a stabilization in oil prices, in the financial markets, and even in China is necessary to comfort the Fed on its medium-term scenario. In such a short delay, the probability of these factors to improve is quite low. So the most probable scenario is that the Fed will begin its normalization process in December or even in the first quarter next year. Regarding the US scenario, we stay confident on growth. Fed's forecasts point towards a moderate growth trend, with median GDP at 2.1% this year and 2.3% next year. Our scenario is slightly more positive, with 2.3% expected this year and 2.6% expected next year. We do think that domestic demand should continue to drive growth, consumption should remain on a positive trend thanks to job creations and low interest rate environment. A better trend is also expected in capex, but uncertainty is still coming from the energy sector and the negative impact from low prices and projects in this sector. In the short term, emerging countries will benefit from no further constraints from interest rates and USD. Thus, they will have some time to implement reforms until the Fed begins its tightening cycle. The US dollar has slightly weakened against the euro. The euro relative strength could be a future problem for the ECB's inflation scenario, recently revised down, and export performances of the eurozone. At the end, the low growth, low inflation scenario associated with low nominal interest rates will probably stay in place for a longer period of time than expected by central bankers and the markets.